St. James's Place shares trade at 1,277p today, after UBS raised its price target to 1,530p, a 20% upside call, while simultaneously embedding a structural collapse scenario into its base case. That combination is not a hedge, it is the central paradox of the stock right now, and it sits in a single analyst note published this morning. The bottleneck is not whether the wealth manager can grow, it is whether the growth engine, client net flows, can survive the AI disruption UBS has just moved 3 years closer. UBS previously assumed artificial intelligence would begin displacing St. James's Place's face-to-face advice model from 2030. This morning, that assumption moved to 2027. The shift matters because it is not a tail risk anymore. It is inside the medium-term earnings window the market is currently pricing. Analyst Nasib Ahmed happed the buy rating because second quarter equity market returns of around 10% lifted funds under management ahead of consensus, and that market performance engine alone can sustain asset growth even as client flows slow. But he also penciled in net inflows turning negative by the end of the decade. The holder facing this note must simultaneously accept a near-term earnings upgrade of 11% and a structural assumption that the pipeline feeding new money into the platform dries up within 4 years. That is not a story the market has a clean framework to price.
St. James's Place grows funds under management through two mechanisms: the returns its portfolios generate and the new money clients bring in. For most of its history, the advice-led inflow engine was the defining competitive advantage. The firm's 4,700-plus partner network generates client relationships competitors cannot easily replicate. UBS now forecasts gross inflows of £5.45 billion and net inflows of just £1.45 billion for the second quarter, running 7% and 17% below market consensus, respectively. That shortfall is not a one-quarter aberration. UBS builds flows continuing to shrink, turning negative by 2030, and attributes the deterioration specifically to AI-driven advice tools competing with the face-to-face model. The argument is that clients who once needed a human advisor to structure an investment portfolio will increasingly access comparable guidance through digital platforms at lower cost. If that substitution accelerates, St. James's Place loses the one input that is genuinely its own. Every pound of market return is available to any competitor holding the same assets. The tension reset is here. The very strong Q2 market performance, roughly 10% returns, actually masks the flow deterioration rather than compensating for it. FUM of an estimated £241.5 billion, some 9% ahead of analyst consensus, is primarily a market gift, not a business development win. When markets reverse, both engines fail at once.
St. James's Place trades at approximately 11 times UBS's 2027 cash earnings forecast. Quilter and AJ Bell, its closest UK wealth management peers, trade in a range of 14 to 18 times. That gap is not unusual. St. James's Place has carried a discount for several years, partly reflecting the prolonged remediation program and regulatory uncertainty. But UBS's note introduces a second explanation that is harder to dismiss. The market may be applying a structural discount, not a temporary one. The buried assumption in the consensus view is that the face-to-face advice premium, the reason clients pay more to use St. James's Place than a digital platform, will persist indefinitely. That assumption underlies every model that values the firm on a mid-teens multiple. UBS has now publicly challenged it, and done so within a buy note, which means the market cannot simply dismiss the challenge as a bear call. The disagreement is between two valuation bases inside the same institution on the same day. If the AI disruption scenario proves wrong and flows normalize, 11 times is almost certainly too cheap for a business with £241 billion of assets growing at 5% per year by market returns alone. If the scenario proves right, and advisory flows turn negative by 2030, 11 times may still be expensive because the earnings power will contract. The half-year results on 29 July are the first live data point that discriminates between these two readings.
The question is not whether St. James's Place can grow funds under management. Market performance makes that likely in the near term. The question is whether net inflows are already on the structural decline path UBS embedded, or whether the quarter's flow shortfall is noise. UBS expects net inflows of £1.45 billion for the second quarter, 17% below market consensus.
If the 29 July half-year results deliver net inflows materially below that already cautious forecast, the AI disruption timeline moves from a base case to an observed trend, and the multiple compression that comes with a structurally declining advisory business is a separate and much more severe repricing than the market is currently applying. The counter evidence in the pool is limited. The My Pension Expert sale process, which UBS flagged earlier in the week, attracted a valuation of 16 to 17 times forward earnings for a 24-advisor firm with $1 billion in assets. That transaction, if completed, provides external validation that private buyers assign a substantially higher multiple to UK advice capacity than St. James's Place's public listing implies. It does not resolve the flow question, but it does establish that the discount is not universally accepted. The entry setup reads as follows. If 29 July net inflows come in at or above the UBS estimate of $1.45 billion, the AI disruption scenario remains theoretical, and the multiple gap versus peers is hard to defend at 11 times. That becomes an opportunity. If net inflows disappoint below $1.45 billion, the structural case tightens, and the discount is not a gap to close, but a signal to respect. Watch the net inflow figure on 29 July, not the headline FUM number. Market returns will flatter FUM regardless of what clients are doing. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.